So good afternoon and welcome. I'm Kim Oosterlink. I'll be the chair today. We are very happy to welcome Maurice Chularik today from Bonn University, CEPR and Sciences Po. You probably all know Maurice through his large publication record. So we are very happy to have him here today to talk about superstar returns. But before we start, I'll just remind you the rules of the game. So if you have a pressing question, a clarification question, please put it in the Q&A. I will have a regular look at these and I will interrupt Moritz if there is a question, a clarification question. For the more substantial questions, the real questions, I would say, please wait after 40 minutes after the presentation. We'll have 20 minutes of questions where there again, put them in the Q&A. I'll collect them and I'll ask them to Moritz. And then we'll have 15 minutes of informal discussion afterwards. I think we're ready to start. Moritz, if you're ready, I think we can start the seminar.
Wonderful. Thank you so much, Kim. Thanks, Rui. Thanks, Nathan, for having us. I'm going to share my screen. And I will start by saying that I am doing this from Vienna, where I'm just very much enjoying a guest visit. We have a little bit of a delicate internet situation, so that is something that I hope will hold. I'm very happy to present joint work with Francisco, Martin, and Sebastian. Francisco Amaral is a PhD student at Bonn, Martin Domen likewise, and Sebastian actually in the interdisciplinary, multidisciplinary spirit of this story of this paper is an economic sociologist who's now at the University, Free University of Berlin. Our paper is called Superstar Returns. And let me tell you what we do in this paper. We study the within-country geographic variation of total returns to housing over the long run. We have data for 27 urban centers. We call them the national superstars in 15 advanced economies over roughly 150 years. I'm going to tell you a little bit about the macro historical data work that we did for this paper in a few minutes, but I think many of you will appreciate, those of you who've worked in housing and then in geography and like in spatial economics and history will appreciate how much work went into this. And obviously we are indebted to a small armada of research assistants in addition to all the work that we have done and Francisco, Martin, and Sebastian have done. So what we're going to do then is we're going to identify the mechanisms that drive the within-country variation in returns that we uncover in the paper. I don't want to spend much time. 40 minutes is short, and there is a lot of meat in that paper, meat both for the macro crowd and meat for the historical crowd and meat for the finance people. Let me just say that much, that clearly we do understand now that housing is the most important asset in household portfolios. It's not only the largest, it's the most widely shared, and it's at the same time, it has a number of characteristics that make it very special. It is indivisible, it's location specific, it's kind of clunky for most people, and it is the asset that we know least about. If you think about all the papers that fill up whole libraries about equity risk premia, it took us quite a while to get a long run perspective on housing markets going, and some of you in the room have done amazing work on this. We don't know much about the spatial side. We have long run, at least on a comparative perspective, we have long run data on national housing markets and national housing returns. But this paper aims to break sort of new ground in looking at the spatial dimension and thereby taking something serious that, as I mentioned just a minute ago, is characteristic of housing, namely its location specific nature. We don't, very few of us own a claim on a diversified national housing stock, which is what most macro models assume. with very specific risks that we incur in specific locations. And I think the next round of heterogeneity and portfolio research will heed that dimension of heterogeneity as well. What do we find? Well, the first and for some of you surprising result is that the national superstars, the big cities, feature significantly lower long-run housing returns than the rest of than other parts of the country. That might come as a surprise because many of us, me included, are under the impression that actually it's the New Yorks and the Londons and the Paris of this world that have been doing exceptionally well, and house price dispersion has increased. So prices in the province are much lower than in Paris, and increasingly so. And we also find evidence that that is true. We find that capital gains in the big cities are higher. But there's a second component, and we'll talk a lot about that second component, that is the rental return. And the rental returns are considerably lower in the big cities, which is something that, you know, the price rent ratios are much, much higher in London than they are elsewhere. And if you put these two together, you end up with the result that we find consistently across countries, that the combined return, the total return coming from both the rental side, and, you know, if you're an owner, it's an imputed rent, and the price appreciation, the capital gain, is that combination, that bundle, is lower in the big superstar cities, and the big and superstars here are national superstars. So, you know, Oslo would be the superstar for Norway, are about 90 to 100 basis points lower per year than returns outside. And that's driven by the higher rental yields that you get in second-tier cities and in more rural regions. We also think we have an idea, and we test that idea, why that is the case. And the reason is very simple. The reason is that everything that makes a superstar, the diversified economy, the agglomeration economies, and the job, the diversity of professions, also the liquidity and the size of the market relative to smaller parts of the country or smaller cities in the countries, make them safer in a financial way. And safer means, we'll look at this, what it means in detail, but superstar real estate is comparatively safe. It's liquid, it's diversified, and so large cities show a lower correlation between housing returns and income risk, which is, if you think about macro asset pricing, is the pricing kernel. So when you have less correlated income and returns, and these markets are less liquid outside of the big superstars. The superstars are liquid, and that means there's less sales specific, what is in the literature called the idiosyncratic component of risk is lower. Remember, idiosyncratic risk in standard finance is not priced because you can diversify it away. In the real estate world, that's not true, because we own individual houses. We can't diversify away the idiosyncratic risk, and the idiosyncratic risk is higher in smaller places outside the big superstars. And we'll hope make a good case that this is quantitatively true in the data. Okay, outline is some data, then long-run city level housing returns, comparing them to the national portfolios. We're only going to move in after having this long-run picture from our 27 cities. We're going to go into 2 case studies where we have returns over the entire city size distribution, namely the US and Germany, for the second half of the 20th century up to today. And then in the last part, we look at the risk differences and the drivers of the returns that we find. That's the outline. Good. On data and methodology, here's our country sample. It's just jumped right in. And you'll see it's European heavy, but we have Vancouver, Toronto, New York. We'll hopefully get more as Ronan and his team in Dublin are producing more North American data. We have Tokyo. We have a couple of Australian cities, And then we have a bunch of European countries, so cities and countries. Importantly, we have London, Paris, Madrid, Zurich, the Frankfurt, Berlin, so the clear, like the main cities that are still today. We also have some smaller ones, Basel, you would not necessarily call a superstar. Those are in the sample because they were, large cities, large agglomerations in 1900. So we define national superstars not exposed but ex ante in the year 1900. And at that point, they had more than 1% of the population in the country. And that is the cutoff we use, in addition, of course, to data availability considerations to define superstars. Amsterdam is in there, and Copenhagen, Stockholm, etc. So for the main European countries, also those, of course, with good macro data, we have a pretty much a good and complete coverage. The data set that we have put together for this paper has not only price data on the city level, but also has rent indices on the city level, typically taken for city yearbooks. And we combine those with rental yield benchmarks that we start with more recent ones because they're comprehensive, but then we cross-check and double-check them over time with additional information to make sure we have a reasonable rental yield benchmark verification every few years. And then we use to calculate total returns as I mentioned, the bundle of capital gains and rent returns. I'm not going to go into the detail of the time coverage. For whatever we do, we have 1870 to 2018. For some parts of the paper, we only use the post-war data, but I will tell you when that's the case, and we can look at the by-city data later. Maybe you have ideas where we can fill in some gaps. About 50%, we looked at that, of the data is composed of new series. That also means for the other half, for the other 50%, we stand on the shoulder of giants in the literature who've done amazing work on individual cities, on individual countries, existing research. You've mentioned the Eichholz et al. Papers, but there's many of you who have contributed to that, and we're extremely grateful that we could use that. Where we had constructed new return series and new both price and rent series, we construct quality adjusted house price series whenever possible. So either repeat sales method or hedonic regressions, and at them, obviously, we put them out as soon as possible, and have put them out for public use in the JST database. Here's an example from typical gaps that we filled. For example, for London, I think there was a gap for the immediate post-war decade, post-war with 2 decades. So we went to property market gazettes and newspapers to fill in some of these gaps. On the right-hand side, you see a city yearbook for the city of Frankfurt, where you have the average rental price of different apartments depending on the room size at these benchmark years, 1895, 1905, 1910. And you also see on the here on this scale, and if you can't read the German, no problem, the different areas, the different quarters in the city. So a lot of work especially went also in the construction of these new rental price data. Okay, so sample selection, just a quick word. We focus on the advanced economies from our JST database, from the macro history database, simply because we need some of the macro control variables, and we want to compare the city, the big, large agglomerations, the superstars, to the rest of the country. And for the rest of the country, we can rely on the national data. More on this in just a second. Sample selection, we cover the largest cities within each country in terms of the 1900 population. This ex-ante choice reduces survivorship bias, and the threshold is we have to have at least 1% of the country population in 1900. That's the reason why some of these smaller Swiss places, for example, come in, like I think Bern was in there for some time in Basel. But none of this is you know, and then there's obviously the usual pragmatic compromises that one has to do in terms of so some cities that we would like, we didn't get the data, etc. Definitions and methods, no rocket boosting technology here. Housing return is the sum of the capital gain and the net rent return. Net is net of everything that we can net off except for taxes. So it's net of maintenance, net of depreciation, net of administration, etc. We started with current day net rental yields from institutional investors. So this is really the payout that an investor gets after all the costs are subtracted. Yeah. And then we're using price and rent indices to calculate rental yields backwards. And I mentioned we have these regular interval checks for rental yields at historical dates to make sure that the rental yields don't, small errors can compound quickly over long periods, that they don't run out of sort of historical plausibility. Okay, let's jump into some returns. If there, Kim is going to interrupt me, I guess, if there are any questions. So this is the distribution of total returns that we see in the data. These are log points in the long run, and the mean is about 5.5% after inflation, so 5.5% in real, standard deviation of slightly above 11. You can see there are there are disasters in housing markets, and then there are also moments when prices really rise very fast. If we look at this by city, maybe you get the city sample here, and this is more relatable. London, New York, Paris, Berlin, starting with the really big ones in Tokyo. For the full sample round, we're in this range of about 4 to 6%, a little bit higher post 1950, and pretty consistently in the range from, call it like 3. Rome has not done so well, to up to 8%, depending on the city. The national superstars now, compared to the national stock markets. Kim, I'm just wondering, everything is fine? You can hear me, etc. Yeah,
don't
okay.
worry, I will stop you. Everything's fine. I should have said so. Don't worry.
Okay.
It's crystal clear.
My
There's
internet,
no
not that I'm talking here for hours and you.
No, don't worry.
But you're there. Okay, good, lovely, good to hear. Okay, so national superstars versus national stock markets. Just plausibility check and some interesting information, I guess. So let's, for the full sample, London roughly in line with the UK stock market. I think a consistent pattern is that in the US, the equity market beats the housing market, both full sample and pre-1950, and it's also true for New York versus the stock market. In France, and it's the other way, also that's pretty consistent with the national data, that Paris did better than the French stock market. All in all, these are similar dimensions, and hence reinforcing one of the message from our return on everything paper, that over the long run, the total returns on real estate, and these are, this now is in the old paper was the countrywide residential housing stock, was comparable to returns on that could be earned in the stock. We're warming up to the core point of the paper, that namely the comparison of the superstars to the broader country, and we're warming up in the sense that we look at the return composition. So what is the return of rental and what's the capital gain? This is for the superstars as a whole combined, and you can see there's the green line, there's a volatility in the capital gains. And then there's a rental component, which looks much more stable. And then the red or the pinky bars are the total return that come out of that. There is cyclicality coming from the much discussed swings in housing markets. Compared to that, the rental returns are much more stable. And you already get a sense from an asset pricing perspective That's a big part of your return. Look at this, is roughly maybe 4% on average. Of course, the capital gains can be higher, but they're also more fluctuating. And so a big part of your return base in real estate markets is quite stable. Comes from the rental yield that fluctuates much less than the capital. Okay, comparison to national housing portfolios. We're going to merge the city, the superstar individual city data with the national housing returns. The national housing returns have the big superstars in them. So we're also going to construct a national index without the superstars. We cannot do this on a market cap basis. We can only do this on a population weighted basis. That's as the superstar real estate is more expensive. That's going to be underestimating even the share of the superstars in the national portfolios, but that's as good as we can do. Anyways, so we're going to start in 1950 now to exclude periods when the national markets are very close to, especially in the smaller European countries, very almost identical with the bigger markets. This also allows us to exclude extreme events like wars and all the things that happen in war times, not destructions and price and rent freezes, etc. This being said, it's in the appendix. We also do the same for the whole period, and it doesn't move our results in any not by an inch and in a meaningful way. So here's I think the first, and then what's going to come is going to be in the same spirit. And I notice I have to speed up a little bit. I have 15 minutes now. So Paris compared to the rest of France. Capital gain in Paris, 4.85, higher than in the rest of the country, about 40 basis points higher per annum. Over time, that's a big difference. The rest of the country, this is what I mentioned, this is the population weighted rest of France, excluding Paris. The difference gets even bigger, 50 basis points. But the rent return in Paris is considerably lower. It's 1% or up to 140 basis points lower per annum than in the rest of the country. And if you add these two up, you get the result that the total return in Paris is lower than the total return in the rest of France. All of these are repeat sales hedonics. Coverage of France is nationwide. Data are good. The difference is driven by smaller cities and rural areas in France with very high rental yields here. Have very high rental yields. Yeah. Now the same for all of our 27 national superstars and the respective countries they're in, and the results look very similar. Positive capital gain difference for the superstars. They have more price appreciation, but the rent return is lower, and as a result, it's considerably lower, and as a result, the difference, the total return difference is actually negative. And superstars have about 1 percentage point lower annual returns than the rest of the country. Okay, again, if we exclude the superstars from the rest of so we construct this population weighted rest of the country, these effects get larger. Okay, this is it. Over the long term, these both are possible, namely the idea of increased house price dispersion because of the capital gain difference between the national superstars and the national portfolios. So you can see here how over time a 50 basis point annual difference in price appreciation leads to large absolute differences in real house prices between the superstars and the rest of the country. But you can also see, like, if in the next we're going to look, here is capital gains. In this chart, it's the total returns. And you see that over the long run, because the total returns are higher in the rest of the country, in the other parts of the country, the overall returns with reinvested returns are more than twice as appreciate by more than twice the rate. Okay, I'm not going to do all these robustness checks that I hope we can talk about in the discussion, because that's what's definitely interesting for us as historians. That is this true for sub-periods? How important are these rental yield benchmarks? What about rent regulation? What about tax regimes? What about if you only take the largest city per country? What if you look at returns by city? Is this driven by some outliers, etc., etc.? And none of this is, you just trust me for now with an eye on time. None of this is going to overthrow what I just told you. Okay, so if you're still doubtful, if you're still not a believer, then we're going to give you evidence on two countries which have very different housing markets. One rental-based, lots of regulation. The other one ownership-based with little regulation, but also like a kind of half socialized housing finance system. And we're going to have the entire city size distribution for these two countries after World War II. For Germany, a little shortest from the 1970s. And we're going to test the same. Do we find in the US, in the German case, that the total returns decrease by city size? Very simple question. The answer is going to be yes. So for the US, we have 317 MSAs from 1950. For Germany, on decadal data, so we use the Yoko et al. Superstar paper and update it and add some bells and whistles. For Germany, we have up to 127 cities from 1993 and 42 from 1975. So the coverage is not quite as good as for the US, but it's also pretty decent. And this is also new in this paper. Here's the US, 317 MSAs by population size, so ranked by population size. On the left, the smallest MSA by population and as you go to the right, you go bin by bin into larger population size groups. And on the vertical axis, you get the total returns in log points and with a 95% confidence interval. Two very nice, I think, insights here, and there is no, the data are as good as it gets in terms of measuring sort of rent and prices on an MSA level in the US over the past 80 years or so, 70 years or so. Is the first insight, decreasing returns in city size. Quite, it's not continuous in that sense, but it's you get the big picture seems to be that larger MSAs have overall lower total returns. And if you look at the tails of the distribution, the smallest, compare them to the largest, you get very, very also like economically meaningful back to our almost 100 basis points in and statistically significant differences. We can test this. I'll skip this. Just trust me. It is a similar picture. Capital gain differences in favor of the large, but rental yield in favor of the small. Total return in favor of the small. Germany. I was about to say it's getting repetitive in the sense that it's the same picture. The difference in yearly log returns for 42 German cities from 1975 to today. Rent returns, and that's still true if you like open a random real estate search engine for Germany and probably for many other countries, you will find a very similar picture, that you get much higher, much lower price to rent ratios outside the big cities, i.e. higher rental yields outside the big cities. And that's what we see here as well. The rental returns are percentage point or so larger. And that more than overcompensates for the small, higher capital gains that can be had in the big cities. Okay, so I have 10 minutes left to give you an idea for why we think this actually makes a lot of sense, what we find here. When we've presented this before, the few times that we have this, at least in my experience, there was always half of the room who said like, yeah, that sounds about right. Large cities are safer, so they should have lower returns. And half of the people in the room, typically those who don't come from finance departments, who said, no, how can that be? That's impossible. We all know that New York did much better than our favorite Casper, Wyoming location that we talk about in the paper. So why do we think this makes sense? That the superstars, despite being called superstars, are actually not superstars when it comes to returns. We have four main findings, and I think we can summarize them in a parsimonious and explain them in a parsimonious and sort of a quite neat way. The four findings are that large cities have higher capital gains, but lower rental returns than small cities. The difference in rental returns is larger than the difference in capital gains, And as a result, I mean, that's implicit in the first three, is that the large cities have lower total housing returns. How can we make sense of this? Well, start with the following thought experiments. Just assume you have a large city A and a small city B, and you make the assumption that A, over the very long run, rational expectations are a good approximation of reality. We're not saying there is no behavioral story in housing markets, not at all, but we have these very long run data. So these biases, if they come from sort of non-rational expectations, and again, we're very open to discussing them. There are, households doing things in housing markets, and there's substantial evidence that this is not sort of by the book of full information rational expectations all the time. But then we have this very long run evidence. So these biases would have to be very consistent and very consistently in one direction. We start with sort of rational expectations set up here as the benchmark for that. So assume that large city A is safer than small city B, and you have rational expectations. What would this give you? Just a difference in risk. Well, the difference in risk in equilibrium would say that expected risk-adjusted returns need to equalize. And that means that total returns are higher in the risky city B. Now, sort of returns in A are smaller in risk city B because risk adjusted, they have to equalize. And now you can just write this inequality here that sort of the rental return in city A, in the large city A, plus the price appreciation in the large city E has to be smaller than the rental return plus the price appreciation in the small city. Now, because of the assumption that this large city is safer than a small city, that means that investors will be willing to pay a higher price for the same rental cash flow. So assume they have the same rental cash flow, whatever, 1,000 euros per month. Investors will discount the cash flow in the riskier, smaller city more strongly, and put differently, investors will be willing to pay a higher price for an identical cash flow in the larger and safer city A. And then what we know as well is that the difference in rent returns is larger than the difference in capital gains. So that means that in the difference between the rental returns that we'll get in the large city and the small city is smaller than the difference in capital gains. Yeah. So these three facts are very nicely compatible with our overall idea that it could be risk differences. I haven't shown you any risk difference. I'm just saying you, like, as a framework, the assumption of risk differences between large and small cities would exactly give us these implications, namely higher returns in the smaller city, in the riskier city, a larger, a lower price for rental returns in the small rental income in the small city for the cash flow, because we discount that at a higher rate, and then as a result that the difference in rent returns between those two is larger than the difference in capital gains, because we know that overall the higher returns must come from the smaller cities because they're risky. Okay, so this is just purely assumptions. Now I'm going to show you as an illustration. If you make these assumptions, you get pretty much what we find in the data. But what I haven't shown you is that is actually real world evidence. Assumptions are easy to make. Actually, real world evidence for risk differences between large and small cities, and this is what I'm going to spend my last 5 minutes on. There are two sources of risk that that one can think of in housing, and both have been discussed in the literature, and we think that both are at play. The first source of risk that differentiates small and large cities is the covariance risk. What does this mean? This is the classical risk that consumption-based asset pricing is built on, namely the idea that an asset is valuable if it pays in bad times, or put differently, the less correlated an asset return is with your income or consumption risk, the more you want to have it, because when you need it most, it is there for you to ensure you to pay a high return. So one reason, excuse me, one reason why small cities could be riskier is I think comes intuitive to many economic historians and urban economists, is that small cities are more concentrated in certain industries, so they're more exposed to industry-specific shocks. So think about a small town that's you know, in the southwest of Germany, that is is very concentrated in the industry for car manufacturing, and it deals with it was world market leader in building some diesel engine parts. Now comes an industry specific shock. Diesel engines are no longer the future. So housing in that housing returns in that very concentrated city might be very highly correlated with your income risk. If you work as a worker for that company, you will find that you lose your job because your company goes out of business, and just at that moment, it's also when your house loses a lot of value. So it could be that the covariance between income and housing returns is higher in small cities. That's number one we're going to test. And the second is what I mentioned in the introduction, is idiosyncratic risk. So idiosyncratic risk is typically not studied a lot in finance, because the assumption is you can diversify it away by holding a bigger portfolio where these idiosyncratic risks aren't correlated. But houses are illiquid, and idiosyncratic risk is likely priced in the market because we own one house or two, but not the whole housing stock. So is idiosyncratic risk, and in our case that will be house specific sales risk could be higher in small cities. Just to give you the intuition, imagine you have there's a market price for your house. Let's say it's 500,000 euros, and in a at the point of sale, when you want to sell this house, there is a risk that you don't realize that market value. There's some error term that is idiosyncratic, that has nothing to do with the market-wide or even with like local conditions. You can control out the zip code, etc. But where there's some issue, probably closely linked to liquidity, where in a smaller market you need to match with a buyer, and that buyer might not be around, whereas in a big city there's always someone who wants to pick up that kind of almost standard apartment in the Lower East Side in New York. Okay, so last minute, is there evidence for both of these risks being higher in small cities? The answer is clearly yes. First, we look at covariance risk between mean family income and housing returns from census data for the 316 US MSAs, and the answer is yes, large. There's a big difference, large versus rest, large versus small. Correlations between income/consumption risk and housing returns are much lower in big cities. They're diversified. If if some industry in New York City doesn't do that well, advertising doesn't have a good year, some other industry will have a good year. Second, idiosyncratic risk. Here we rely on the methods developed in a very nice Review of Financial Studies paper by Giacoletti, 2021. We estimate idiosyncratic risk as the remaining risk at the point of sale after controlling for all observables, all house price characteristics, and all zip code effects and county effects, etc. These are micro data from CoreLogic, and again here we find that idiosyncratic risk decreases in MSA size. Yeah, so one reason is so these are the small MSAs here, and these are the large MSAs. Idiosyncratic risk, this residual risk that you have at the point of sale when you want to get rid of a precise individual micro property, that risk is lower. It's easier to sell this apartment and realize the market value in Amsterdam than it is somewhere outside in the countryside. Yeah, so that decreases, and It's probably, but I'm going to stop here within our time. It is closely correlated with liquidity. That's a main driver. In large cities, housing markets are liquid, turnover is high. Try to sell a house somewhere, you know, in a remote location. You need to find a buyer, a match with a buyer, and that takes longer. And it's not as certain that you get something close to the market value of your house. Okay, that's it. That's the paper. That's been 3 years of data work. I hope it was worth it. We're open to suggestions and improvements from all kinds of people. Thanks again to all of those among you who have, in one way or the other, answered question, helped with data, been extremely helpful in this big exercise. You all get loud shout outs in the paper. And so the main story really is superstar returns. Superstar cities are safer, and that lower risk is priced and reflected in lower long run returns. Thanks so much.
Thanks, Moritz. I'll start with the questions that are in the Q&A, and I'll gradually ask them. So there's one question by Tony Moore, who asks whether, say, is there any contribution from state housing benefits? So say house prices in, say, northern UK towns may be very low, but there's a floor on rents provided by minimum housing benefits, thus increasing the rent price ratio. So basically, to which extent is this kind of regulation affecting your results?
Right, I can see the point. I don't think, I mean, this is first of all, a result that's very consistent across countries. And these countries have very vastly different rental regimes and subsidy regimes. So the idea that there is a floor put onto rental in some areas rather than others might play a role in the individual case. So the question certainly has merit. But typically you would also see that a lot of the social housing is in the big cities, because these are the big sort of centers. And so that would not, it's not clear if that would push the differences that we observe in either direction. And more precisely, I can go back, and I dare, now that I know that my internet is more stable than I thought. We've looked at rent regulations and asked, so there's this nice paper by Paulo Dillin from DRW in Berlin, who coded rental protection regimes, or rental regulation regimes. And so we just used his classification and said, okay, these are the weak regulations, these are the strict regulation regimes. And we don't find, you see this here in the table, for the total return, the rental return, and overall the capital gain differences, it doesn't seem to matter whether you're in a weak or strong rental regulation regime. I could talk more why that makes sense from a finance perspective, because that's priced in, it's forward-looking, but I think it's a good question. It's not gonna rock the boat.
Okay, I'm gonna move on to the next question by Peter Solar. So your explanations focus on consumer behavior. Another potential difference between small and large cities is the degree of competition in mortgage markets. This could be different across city size, and the difference could be decreasing over time. So it's basically the way you finance your housing. How does that affect your, do you have regional disparities regarding mortgage markets?
Right, I think that's a fair comment. And you might say that the mortgage availability was regionally differentiated, at least in times before we had like integrated financial markets, maybe starting in the last, 30, 40 years. Now the question then is, would that go against us or for us? Because one idea would be that the mortgage availability is easier, financing conditions better in the big centers, where where you have the pools and pockets of finance, where you have the opportunity, whether you have the banks and the financial intermediaries, and it would be harder to get mortgage credit outside somewhere in a rural area. And that would, I mean, to the extent that availability of finance has an impact on prices, you could say that puts pressure on prices and makes it harder. I mean, yes, you could also argue that with lower financial availability, the higher rents for those who have built. I would need to think about that, but it's not clear ex ante to me whether in which direction that would push the results.
Thanks. So we have a question by Dixila. So your rent return is net gross rent minus cost. Could superstar cities have lower rent returns because costs eat up a higher proportion of gross rents? So basically, yeah, if it's more costly to run, I mean, to be active in a big city.
Well, wonderful. But first of all, hi Dick. Good to know you're out there. Could we? Does the gross rent? Does the cost higher in big cities? Well, I have two answers to that, and they're both more or less anecdotal. We look at, I mean, for both we take net rental yields, so we're comparing apples to apples. We have net rental yields for the small cities and net rental yields for the big cities, and for the US you get them from the REITs, you get them from the investment, the real estate investment funds. That's not a problem. So we're always comparing net rental yields. In terms of whether the costs are higher in big cities, I think there's two ways to think about this. One is yes, because everything is more expensive, wages are higher, it costs more to fix something in New York City than in Vermont. But on the other hand, the nature of the properties being more towards on the sort of single family housing and having more dispersed regional dwellings in the end. You have to travel larger distances. It might cost more maintenance to keep up like individual houses. I think it does cost more maintenance to keep up individual houses, single family houses, than apartment blocks. So again, it could be big, it could go in both directions. If I remember correctly, I don't know if Francisco, I don't see the I would see it, but if Francisco and Martin are on, they might have looked at this in bigger detail. But that's as good as my answer can be at this point.
Okay, so I'll since there are no more questions, I'll ask questions myself and take my.
On, so maybe he can come in.
So I have a series of questions regarding what you do. So there's a question about the definition of a city in a sense. So I was thinking about Paris. And it goes in your direction. So if you think about Paris, and if you take Paris intramuros, so the 20 arrondissement, then basically you know that nobody's going to build anything new there. So the idiosyncratic risk that someone creates something awful next to your house is close to zero. That might not be the case in smaller cities. So in a sense, my question is, when you say Paris, are we looking just at, I mean, Paris or New York, are we just looking at the old city, or are we also including part of the suburbs? Because in a sense, I mean, to which extent is the definition of the Paris the same across time, and to which extent does it include suburbs?
Right. So we use the definition of the city that we have in the official documents, and as you rightly say, some of these change over time. I think in the Parisian case, the borders are pretty set. I know, for example, in the case of Berlin and others, the city limits expand over time, and as these sort of, as you build the private infrastructure, the public infrastructure, transport infrastructure, etc., that build these big cities over time. I'm not 100% clear what, again, if we're comparing London and as it grows over time, also as an administrative unit, we use that administrative unit that we find. Again, I'm not 100% sure whether it would introduce a systematic bias into our results. You would say that maybe the price appreciation in inner Paris has been even higher than if you include the suburbs around. But then you integrate over time, you integrate suburbs with these reasonably high rental yields. So if the total return bias shifts a lot, I can't say, but we should definitely look at this in greater detail. Yeah.
There's a question by Peter Sordi, which is linked to what I said somehow. Say, how might the growth in population affect your results? Do initially small cities tend to grow faster than initially large cities? So I think there's a question of this dynamic about my question about city definition in a sense. I think Peter's question is about cities evolution. So I just this is the question.
I mean, yeah, no, it's a good question. So maybe I can try it this way again. What we do in the paper is we collect data for these big cities and then compare them to the rest, right? So, and these big cities, they are not fixed, but by 1900 or so, Paris and London and Berlin were pretty much as like the larger administrative unit. So we're not looking at like a very narrow, but as a larger administrative unit, like an MSA type of unit, were in existence. So I'm not 100% sure how much the changes in the city boundaries around the edges would affect our long-run return data. For the rest of the country, that is the fast-growing part. Although I'm not even sure that is true. I think urbanization rates were very high in the 19th century and have remained reasonably high ever since. So I'm not sure we get these differential growth rates between the big cities and the rest of the country. For the rest of the country, we just have these diversified broad indices. So individual fast-growing cities would not, in my view, would not affect the picture in a meaningful way.
Okay, well, there is a question by Nathan. Nathan?
I'll mute myself. Hi, Moritz. Again, great paper. So maybe my question may lead to more data, but you're very good at collecting data and analyzing it. But one way to look at maybe the idiosyncratic versus the co-movement and other things is to look at mortgage lending rates, because banks can diversify. So they're not exposed to idiosyncratic, like a single house thing. And is there a difference? I mean, you might be able to use this as some kind of an instrument or something in your work, or some kind to evaluate the extent of the importance of these two, co-movement versus idiosyncratic. And I think it will be a nice, again, I'm asking you to get more data, but I think it would be a great addition to, because, what you've shown makes a lot of sense, this idiosyncratic versus, so it's not a portfolio, you're not buying an ETF or something when you're buying a house, and therefore you're exposed to this risk and it's factored in. And but if you're like on the bank side or finance companies or whatever, that they can diversify, then you might get a feel about this, how big this thing is it important or not in this day, yeah.
I agree, it's an excellent suggestion. We haven't looked at it. I can see this not being quite so easy to get regionally differentiated mortgage rates, but we could. I mean, yeah. I'm thinking where we could go to get a sense for how big these differences are. I think that's a good point. Francisco, on Dick's question, also I just saw this put an important comment. I didn't think of that in the chat, that the land share is of the housing, of the value of the house is much higher in the big cities. So in percentage of the cost, it's unclear. It's really unclear where it goes. I think we don't see higher percentages in the large cities and the rest of the country. But we'll look into this again happily.
Okay. I had another question. Rui has one, so Rui, go ahead.
Sorry, I wasn't trying to stop you, so go ahead. I have two questions.
No,
yeah.
I'll ask my question at 6. That's okay.
Okay, all right. So two questions. So still on consumer behavior. So yet another possible interpretation for this differential in total returns might be so-called emotional dividend, right? So houses are obviously also consumption goods. And this also relates with idiosyncratic risk, but in a different way, right? So could you try also to, measure out this idiosyncratic risk or this emotional dividend from people liking customized houses by looking only on data on transactions on the wholesale market. So I'm thinking, I live in a country now where almost all the housing stock is not owner occupied, is owned by institutional investors, right? So would you guys be able to control for that and see whether that would affect your measure of idiosyncratic risk? And then the other is, it's not really a question or does not require more data, it's just a different way of presenting your results. So you give this very striking difference in very long-term returns, but of course, if you really want to push the story in terms of undiversified homeowner occupiers, then you could also perhaps show this more usefully by looking at the distribution of hold returns over specific periods. So buy and hold horizon. So how long would it take for starting in any random year homeowner in one of these cities to break even relative to inflation or to the stock market or so on, right? So this is just a different way of presenting the data because, of course, even if you find a distribution of returns, say with lower variance, it can still be the case that if there's excess kurtosis, so if there's higher likelihood of black swans, an actual living homeowner might be facing higher risk than in another situation. So those are the two questions. Back to you, Kim and Moritz.
Well, Moritz, you have 2 minutes to answer Rui. So,
Rui, can you the last question? I'm not the one with the emotional dividends in Switzerland. I do those get, but the last one I'm not 100% sure.
So I'm thinking of, suppose you have two return distributions, and one has a lower variance. It's still possible that if it has very high excess kurtosis, meaning very heavy tails, right? If it's still possible, if you're thinking of a 5-year return horizon rather than a 150 return horizon, then if you get in the market on the wrong timing, right? So this is just presenting your data in a different way, right? So
the question of disaster, is the compensation for disaster risk being greater in one?
Absolutely. And you can represent this very easily, right? So imagine, right. So you have horizon, return horizon, and then you have expected return by horizon, and you can get the result that way.
Right. Okay, so I can start with the last one, and Francisco and Martin can jump in the chat if I'm telling nonsense. But I remember we've looked at this, and I think we didn't find differential disaster risk in small versus large cities, because that was kind of the first where we looked thinking okay, if something like 2008 happens or COVID happens, do we see differential price effects on large and small cities, and could that explain, is that part of the risk difference? And as far as I remember, we kind of didn't find much, and then had to dig deeper and looked at idiosyncratic differences, etc. So I'll cut short if you not in a pragmatic way, if you allow the question on Switzerland. Switzerland is indeed, and Germany are a little bit special in because of the low home ownership rates. We didn't find, but different. We do find that in Switzerland and Germany, our basic result still holds. So that ownership structure does not seem to affect the overall finding about that return differential. There's another thing that, this is this heuristic cycle. Once you have something in your mind, you see it everywhere. But there's been a lot of news recently about big private equity funds in the US going into buying single family housing for rental purposes outside the big cities. And the notion was that the black stones of this world found that, actually in a time of low interest rate, you get very decent rental yields in these places, and you can lever it up to almost 100%. So if you're a private equity fund, this is like a free lunch. This is what you want to do. This is your business model. Get some reasonably safe rental income stream that you can lever up a gazillion times, and if things go wrong, there's always the taxpayer to to ensure the housing market risk.
Okay, Moritz, I'll just interrupt you because it's 6 o'clock and I have to make the announcement. I'm sorry, no, but we have 15 minutes afterwards to keep on the discussion. But I need to announce that the official part, or I don't know what the serious part. I don't know what the after 6 o'clock is the more relaxed part. So we'll all be relaxed. Is now over. So we have now 15 minutes of more relaxed talk. Not that this one was very stressful. I need to announce next week's seminar, which is Trade, Financial Development, and Inequality: Evidence from U.S. Railroads in the 19th Century. It's going to be by Dheeraj Chaudhary from the University of Maryland. And you're now all welcome for the more relaxed part where Moritz can keep on giving the explanation he was doing. I'm sorry I interrupted you, but I have to follow the rules.
Yeah, no, thank you so much. It was relaxed. I am very grateful. We're very grateful for these comments. There was something I'm like have some open. Oh yeah, Rui, the emotional dividend. I mean that is. I think what we don't want to say is that what we present as explanation is exhausting. Like there must not be an exhaustive list. There could be, there's a lot of real estate thinking about the role of amenities and the good feeling you get from living in a cool place, etc. And that doesn't have to be behavioral bias. It could just be that there's things that we mismeasure that make something attractive and that somehow is not related directly to risk differences. It's then often how this affects like expected. Is this about expected house price growth? Is this about non-monetary benefits? But it's an interesting. I mean, there's clearly. I think that's why I stressed, maybe last word, this is why I stressed this point so much, that we're not at all saying that behavioral factors do not matter in housing. On the contrary, I think it's the market where households are active, and we know there are all kinds of issues of, that household finance is, full of puzzles where households do things that they shouldn't do, or they don't do things that they should do. And I think for housing, that's an extension of that. So these emotional dividends play a role.
I had I had a very similar question on the one raised by Rui. In a sense, you put yourself in a consumption CAPM. That's what you do. I mean, your consumption CAPM. Consumption is a big part of being, having in a house or living somewhere. So the consumption part gets tricky, because you could say, okay, I'm living in a small city, there's a pandemic, but I probably have more square meters than I'm living in a big city where I have a pandemic and I have limited number of square meters. So maybe something that you may want to include if you do hedonic regressions is something where you actually take into these factors and try to link them with the returns. So for the moment, if you do hedonic regression, you integrate it right away. But the question, you can also use the shadow prices to see what you can infer from people's consumption, in a sense. I mean, I think that might be something to investigate. And the other question I had regarding the methodology, you do both repeated sales and hedonic regressions. So I work on art markets, we do both, but we do know that repeated sales are heavily biased, and it might not be the case for real estate. But in the art market, when the artworks come back to the market, it means there is a market for this artist. It also means that in all likelihood, the artist's value has appreciated, the ones who took him as an investment good. So I was wondering to which extent you see differences when you do hedonic regressions, where you have a broader sample and you don't have this potential repeated bias, versus if you have repeated sales. Do you see differences in your indices if you use one method or the other?
You mean like use the same city where we have repeat sales and construct an hedonic index? Yeah. No, it's a good question. I don't think we have done that, but it's a good way. I don't think I can see that the problem is much more severe in the art market.
Yeah, no, of course, that's why
just don't just disappear as like an unsuccessful artist might be. The painting is somewhere on the wall and never comes back. But no, it's a good. I mean, like now that you say it, I wonder why no one has done this to get a sense for potential biases either way. So it's no. good point. Yeah.
I mean, basically the repeated sales is a nested head-neck regression. You just focus on a subsample where all the covariates are the same because you take the same apartment or the same house. But I think it's an interesting question. We in the art market, it's obviously a big problem. I mean, it's something that where we
it's about because sample selection.
Yeah, there's a big selection bias. So yeah.
I have another question, if I may. Just another little exercise you can do, which would be interesting. So I guess obviously the returns you show, and it's expected in the big cities, is the capital returns are higher. And can you do this some sort of counterfactual, just saying, suppose there were no idiosyncratic costs, stuff like that, what would be the capital return commensurate with the rent to make these things in equilibrium, and see how large the gap or how far off are, because you're measuring ex post returns, and if you're buying a property in New York and not just looking at it, the world doesn't end in 2021, hopefully, and there's some anticipation that this will continue or something, and it would be interesting just to get this a benchmark, as long as you've collected the data, some kind of a benchmark to, under perfect rational expectations, no idiosyncratic cost, whatever. What would be the capital return commensurate with the rents or something like that? That would be interesting, just to get a feeling of maybe infer backwards kind of expectations, long-term expectations of the prospects of these cities or something. Given that, say, idiosyncratic costs are similar between countries or something, or anyway, just do people expect Paris to do much better in the long run than London? It would be interesting just to see these kind of things based on the data you collected.
Yeah, I think I absolutely agree. There's much more to be done with this data set, including sort of like trying to back out these ex-ante expected returns. The problem is that as soon as you put some asset pricing in any paper, there's asset pricing is such a mess that you end up raising more questions than you have. I mean, I like, it's not saying that we shouldn't try, and I think we've talked about this as well. The question is like, by the way, is this risk premium that we find, is that adequate? Is that correctly priced? Is that what you would get out of a standard back of the envelope asset pricing model? But then the problem is we don't have that standard back of the envelope asset pricing model that gives us, fair predictions, because they all don't work pretty that well anyways. At least not anything that's consumption based just doesn't work very well. And so then you can, and I guess what Kim and Rui also said, the sort of this double nature of housing as both an investment good and a consumption good, make it quite tricky to think about standard sort of consumption based asset pricing, where you have an asset that perfectly hedges your housing consumption, which would make it safe, but it also has this very large concentration risk in your portfolio. So it's I think we're going to go there in the next paper, though.
I didn't say now. I was just saying that it's something interesting, and all these consumption values, utility from the house, I mean, they should be relatively constant. And the nice thing is you have this data set with a lot of heterogeneity in locations. You would think people are not that different in terms of why they like certain houses. I mean, not the color of the wall or something. That could be some difference, but in terms of kind of the basic amenities people derive. And in that sense, the heterogeneity of the data you have can say, is Paris overpriced relative, whatever. There'd be some interesting things. I mean, what would be and factor? I mean, it's just I know it's a different paper, but it would be, I think, a fun paper. Maybe I don't know if the Econometrica will take it, but it's something interesting for readers. I think it's really exciting.
There's a question by Tony Moore asking if the returns from investing in small cities are higher for homeowners. Does this mean that renters there are relatively worse off than those in superstar cities? And this side question is, could you construct an optimal portfolio by buying a house in a small city and renting it out, and renting it in a superstar city? So in a sense, it's a question of arbitrage. Can we take your result and make a profit out of it? If I'm making a shortcut regarding the question.
I mean, that depends on if the risk. I mean, if you buy and hold, you don't have that sales risk, then yes. If at some point you want to sell the house, then you incur the risk now that this small place in the middle of nowhere house, it does not get the market price, but gets 10-15% less than the market price because there's just no matching buyer around. I think like I don't know, we don't make any welfare statements. I think I think to attract capital to remote places, you need to offer returns. And so that's a little bit almost like a development logic. So that means like, yes, you want to be, you know, if you're talking about remote Iowa, you probably want to be a capitalist. And because these returns to capital are higher in that sense, it's probably the reason why home ownership rates are so much higher in rural areas than in cities. No, it's like, why pay someone else that high rental yield if you can get it for yourself?
So, and I mean, it's just it's a question I should have asked earlier, I guess. But how do you take into account transaction costs that are huge in some countries when you want to buy or sell real estate? Is it already in your pricing? And when you say capital gains, you put, I mean, in Belgium, transaction costs are massive if you buy a house.
And this is where I would need Francisco or Martin, but I think I mean, first of all, it's about differential. Like, I mean, I think in Belgium the transaction costs are the same nationwide.
No, they're not. We're Belgium. It depends on the regions. I mean, of course we make it complicated. What did you expect? It's not the same if you're in Flanders, in Wallonia, or in Brussels. I mean, of course.
There's one issue about taxation, which in some countries is very regional. So it's not. We can't really talk about post-tax returns. We can just say that in different taxation regimes, that difference is still visible. But I mean, at some point someone will do this, but calculating post-tax returns on housing is, because the taxation is so local, it's an absolutely
true. But I mean, even if you go back to your discussion about rental premium versus capital gain premium, as you said, in most countries it's going to be national. I mean, Belgium is an exception, I guess. But in a sense, if you look at investment in real estate in general, I think that might be something that plays a role. And also the question of whether, to which extent the amount you pay as interest is in Belgium tax deductible, whether your rent is not. So that is also a big difference. And it's again, that is federal, it's nationwide. So we have, I mean, I think there's more heterogeneity that you may want to explore in this respect about capital gains and local differences and how it's treated.
Point well taken. I think that's true.
Okay, it's 1:15. So now
that was amazing. Thank you guys. I learned so much.
Thank you.
Take home a lot of homework. But that was great fun.
Thank you, everyone.
Fun for us as well. Thanks for bringing your paper, and see everyone next week.
And for those I know and haven't said hello in general. And I was glad to see names I knew, and hope to see you very soon.
Perfect. Bye-bye.
Bye.